Well, hello traders and investors. My name is Roger Scott. I'm the head strategist for Wealth Press. Today is Monday. It's the first day of February and it's the first trading day of February. Imagine that. And I'm going to ask you, where is 2021 going? I'm still thinking March, April of 2020, and it's already 2021. I guess it's true. When you get older, time goes by faster. Markets are higher pre-open. We're going to be opening up in about an hour and 3 minutes. Let me show you where we stand right now. In terms of the S&P 500, we breached the 50-day moving average on Friday, and pre-open, we're trading slightly above the 50-day moving average. So far, every time we've been opening higher for the last several days, we've been heading lower, and I'm not holding my breath today either. Now, if you look at the Dow Jones, and these are ETFs that track the actual futures. If I was to show you the futures, they would literally look 99% the same. So if you look at the Dow Jones, it's even worse. It's penetrated deeper, and we're even opening below the 50-day moving average. The Nasdaq looks a little better. Let me show you the QQQ. We're not there yet, but we are legitimately in the twilight zone, which is between the 50-day moving average and the 200-day moving average on the Dow, and maybe possibly potentially doesn't sound very certain, does it? But no, all jokes aside, there's a good chance we're going to start hovering around what I like to call the twilight zone, which is the area between the 50-day moving average and the 200-day moving average, where stocks kind of start looking for direction and are not bearish and not bullish. They're kind of not here, not there. It's actually a good time to do spreads because you have a lot of choppiness during that period of time if the market stays there. But we're not there really quite yet. What I'd like to see is to see 2 days completely below the 50-day moving average or above the 50-day moving average, meaning no price touches the 50-day moving average. So if it's above the 50-day moving average, the low's above the 50-day moving average. If it's below, then the high is below the 50-day moving average. But again, my test is 2 days completely above or below. Otherwise, you're going to run into a position or a situation where you're going to be kind of sitting there on the sidelines. Because look at this thing right here. It tends to congest, tends to crowd around the moving averages before it gives you a good directional bias. So keep that in mind. It loves to hover around the period. So I like to see 2 complete clear days above or below before I call it or call what it is. So that's that. In terms of the weekly news, it's Monday. We've got manufacturing index coming today. That's going to be, in my opinion, so-so. It's not going to be here nor there. Then we've got the petroleum status report that's going to tell us we've got a glut of oil. Then we've got the good stuff coming out. We've got jobless claims, and I'm hoping, fingers and toes crossed, that we're going to go lower and that we're going to continue moving lower. The week before last, we were at 900,000. The week before that, we were at 965,000. We need the number to go lower, because if it doesn't go lower, it's telling us that people are going off. They're not applying for jobs. They're applying for unemployment benefits, and unemployment benefits are not good, and we are near the level we were a year ago, which is sad and terrible. So again, we've got some news coming up. Keep your eye on this consensus number. If it's like 950, we're toast. But if it's 850 or below, I think we'll be okay. Then we've got employment situation on Friday and international trade in goods and services, and this is going to be important because we're getting signs that other countries are starting to get infections again, and that may impact international trade in goods and services, which is how we got into this mess last February and March. It all started with international trades in goods and services. So we're going to keep our eye on that report. Now, in terms of global economy, let me go through with you the biggest factors you need to pay attention to. Global stock market rose. It's higher right now, as you could see here by futures being up on the Dow about 225 points. Why are they up? Because coronavirus vaccine maker AstraZeneca agreed to increase supplies in Europe amid worries about the disease. Last week, they said they were going to decrease or not have enough. The market went down. Now, COVID is still driving this market, folks, and I want you to know that, and it's going to be driving for a while. Everybody was asking me, Roger, what's going to be the biggest factor in 2021? I said, folks, the biggest factor in 2021 is based on what happened in February and March of 2020. That is progressing in itself. That's what's causing the market to fluctuate. That's what's ruling the market right now, COVID. Shares of GameStop swung 13-point range, not bad, between opening bell, before the opening bell Monday. I was thinking between the opening bell Monday. Monday opening bell hasn't rung. It's not ringing for another hour, an hour 59 minutes. Or not an hour and 59, another 59 minutes. With trading still limited on retail trading platforms like Robinhood, moving between gains and losses, folks, stay away from that. That's danger. It's trouble. You don't need it. There's going to be investigations. There's going to be SEC forensic accountants looking into this. Stay away from this mess, really. Next up, silver. Silver almost rose $12 to $30 in London after novice traders announced that they were going to hit silver next. Folks, I'm going to tell you, it's not going to be nearly as easy to drive up the price of a commodity like silver because this ETF, this SLV silver ETF, it's tied into the physical commodity. So if you think the CFTC is going to allow people to drive up the price of silver, I've got a couple of bridges to sell you. They're going to be all over it like white on rice. Anyway, markets were rattled last week by AstraZeneca. That's what I was talking about. Announced it would supply the European Union with fewer than half the promised doses. That caused the market to panic. But on Sunday, they reversed their position, which is why the market is higher today. They promised to increase supplies. Purchase Managers Index. This is important. Issued by business magazine Caixin. This is China. Declined to 51.5 from December's 53 on a 100-point basis. Anything over 50 is expansion. So a separate PMI by the official statistics agency showed similar weakening. It looks like we peaked out. See, data suggests China's rebound is leveling off. And that's bad, bad, bad. And we're hearing rumors, not rumors, fact, that Beijing and other cities in China, big cities, financial cities, are getting their dose of COVID infections again. And that's bad because if we find out that this variant doesn't work with the vaccine, we're going to be in a deep mess. Investors have bidded up stocks in expectations that the rollout of COVID vaccine would allow global businesses and travel to return to normal. Not so fast. The optimism has been dented by a new infection spike and disruption in vaccine deliveries. And who told you that was going to happen? I did several months ago. We're not going to get out of this just like, it's not just going to be a one day we're going to wake up and say, boom, we're done. It's going to be a pain. Investors are watching negotiations in Washington over President Biden's proposal, $1.9 trillion economic aid. I don't know if that's going to happen. I'm hoping that it will, but we won't know anything for at least another couple of weeks. And most likely it's going to be a little smaller. Crude oil prices are at 52 barrel. They are going up, but they have stagnated. And again, there is still a ton. There's a big supply of energy, of crude oil. So I wouldn't get my hopes up that the price is going to continue spiking up. As a matter of fact, let me show you something interesting on the energy sector. This is the energy sector. And it was moving higher, as you could see here. But then, I want to show you, this is important. Look at the period where we were last February. We can't get anywhere near there. So I'm avoiding all sectors that have not been able to generate the level that we were at last February, or even before that. And as you could see by the ugly colored brown moving average, the 200-day moving average, the trend has been going down no matter what, and I'm not really that bullish on traditional energy right now. I'm very bullish on non-traditional energy, but I'm not really bullish on traditional energy. As far as the overall market, bonds, prices continue moving lower, which means long-term interest rates are starting to move higher. Now, we know the Fed is not going to adjust short-term rates, but long-term rates have a mind of their own. Remember, they're based on what's going to happen 20 years from now or 10 years from now. They're like a futures contract. So they are telling us that rates have bottomed out, and when rates go higher, right, bonds go lower. When bonds go lower, rates go higher. And right now, as you can see here, bonds are going lower, which means interest rates, long-term rates are going to go higher, which can put a dampen real estate. Real estate is doing really well right now because interest rates are near historic lows. But again, there is a fear they're going to be going up, and that may do one of two things. It may increase the housing market strength, which is already at a 14-year high, or it may slow it down just a bit. And I think a lot of that is dependent on whether the economy is going to pick up or not. If it doesn't pick up And if there's no money to buy new homes, and if interest rates start going higher, it's not going to be good. But if the economy picks up while interest rates remain low, that's a whole different story. Again, I want you guys to watch out for the Dow. This is the Dow Jones. In terms of sectors, energy and financial are still leading. And in my opinion, these are both still rebounding defensive sectors. So I am not as bullish as I was when consumer discretionary or technology was leading. Those are bullish sectors, and basic materials and industrial are away from each other, which means the market is fragmented. I would be more comfortable getting aggressive when consumer discretionary and technology stocks are leading, not when energy and financial. Because look at the financial sector. Look at what happened when it came up to the price. Look at this. It came up to that price, and then boom, it bounced back down. So it couldn't sustain that momentum like tech did. I mean, look at technology. And look where prices were February. Every time I'm looking at a sector, I'm looking at it in comparison to how it did to March, April of January, February, March of last year. As you could see here, this is where we were. This is the peak, and we're already up here. Whereas if you look at financial sectors, it's not near that. And if you look at the energy sector, it's even worse. So I'm neutral on the market right now, especially with the Dow Jones breaking the 50-day moving average. And there's 3 big caps that are breaking down right now, which are confirming what I'm seeing right now. And this is not happiness. First one, Proctor Gamble. It's breaking the 200-day moving average. This is a top blue chip stock. This is a short opportunity right now. I think the stock is going to go down all the way to the 112 level. It's near the 128 level. That's Proctor Gamble. This is a big blue chip stock, and if it goes down, it'll put some more pressure on the Dow. Next one is Fedex. This was one of my biggest darlings when the COVID was running amok, but it looked like it peaked out right around the Christmas or right before Christmas of 2020. It's breaking the 50-day moving average. It's underperforming the Dow Jones. It's in the twilight zone, and I'm expecting more downside. And if we keep recovering, or if the sentiment improves from COVID, then I believe Fedex will continue moving lower because there'll be less demand for shipping, because people are going to start shopping themselves instead of buying things online and getting them shipped. And that's what the market is anticipating right now. If we find out that the COVID cycle is going to get worse and we go back to the lockdown environment, well, guess what? Fedex is going to rally again. So I'm neutral on Fedex because we're not at the 200-day moving average yet. But again, I wanted to bring this to your attention and show you that one of the best stocks of when COVID was running amok is now breaking lower. And finally, we got Brown and Company also breaking the 200-day moving average. The stock looks like it topped out around beginning of the year. It's breaking the 200-day moving average. If you look long term, you will see that the stock peaked out quite a while back. It's been congesting more or less. It's not really doing that great. And again, it's breaking the 200-day moving average. So if I was betting on the short side, I would bet that this Brown is going to go all the way to the 35 level, and Procter & Gamble is going to go to the 111 level. And Fedex, the question's still mixed on Fedex, but if we continue seeing things improve slowly, but if we continue seeing things improve, we're going to hit the 200-day moving average, and then we're going to go down to the base, which is around the 165 level. So, folks, before I go, I've got something urgent, important, and very, very, very crucial to tell you. Kingmakers. Kingmakers have been around for thousands of years. Have you ever heard of the term kingmakers? They're the most influential people in the world. And right now in the stock market, they consist of people like Warren Buffett, George Soros, Ray Dalio, Paul Tudor Jones, if you will. What do all of these men have in common other than billions of dollars in net worth, right? They can single-handedly send the shares of any stock price of any given stock to the moon. They can literally manipulate the market. They can single-handedly send the shares of price of any given stock to the moon. Trading expert Adam Sarhan, and Adam is a trading expert, he seems to have figured out how to track the moves of these financial juggernauts. He's got it figured out, and I'm going to tell you, Adam is no beginner. Adam is a pro. He's a Forbes contributor. He's on CNBC, CNN. He's all over the place. This guy knows what he's talking about, and he wants to show you how you could take advantage of these massive moves by the kingmakers. He wants to show you how to follow these legendary traders and follow their trades. I guess I would call it shadowing them. But again, if you can learn what these kingmakers are doing, you have the potential to become a kingmaker yourself. And that's something. Click on the link below to get all the details. Again, these are billions and billions of dollars moving the market, and Adam is going to show you how to tap into it and potentially give you a massive unfair advantage. You got to check it out. Again, he wants to show you how to take advantage of these massive moves by the kingmakers. You don't want to miss out. Follow the link below and give me some feedback on these videos. I spent a lot of time on them. I want to hear what you guys have to say. Are they accurate? Are you getting value out of them? Let me know. You have a question you want me to cover? I'll do it. I promise I will. Good, bad, doesn't matter. Leave me feedback and follow the link below. Talk to you guys later. Bye.